welcome to Foxon Media Digital. My name's Amy, and today I'm joined by Piers Hugh Smith, who is Investment Stewardship Manager at Franklin Templeton. So welcome, Piers. Great to have you on the channel.
Thank you very much for having me.
Yeah, of course, you were at TSAM ESG London back in November, and we wanted to catch up with you this year to see what you're focused on in your role, hear a little bit about what you're doing in the stewardship team, and dive into some of those ESG topics again. So just to get started, would you mind telling us a little bit about yourself and about your background?
Yeah, absolutely. So my current role at Franklin Templeton is that I run our global stewardship team, and we're a multi-boutique structure. And so what that means is that we sit in the middle of the business, and I work with each of our investment groups and independent investment managers in order to enhance their ability to be effective active owners. And so whether that be through engagement or collaborative engagement with initiatives like Climate Action 100 Plus, or whether it be in the execution of proxy votes and dealing with proxy season and the changing requirements that clients have, then that's really what me and my team at Franklin exists to do, and kind of build the effectiveness of the team. Before Franklin, I worked for a manager called CCLA Investment Management, which was we did a lot of active ownership there. Their CCLA Investment Management managed funds for the not-for-profit sector. I think they have some retail business, but that was really my kind of foundation in stewardship, was leading on climate engagements and biodiversity engagements of that manager as well.
Fantastic. Thank you for that introduction. Sounds like you've been very busy, lots of diverse work there. So when we talk a bit more about those day-to-day challenges in the investment team, I know these in stewardship team, sorry, I know that you said that you work with all the teams. So how hard is it to sort of integrate it effectively in line with other business units at your firm?
Yeah, so one of the big challenges I think that a lot of large managers have, or certainly very diversified managers, is in prioritization. So a lot of what we do, we cover huge amounts of asset classes, huge amounts of different securities, and we cover, certainly in my team, it's a global coverage. So to put that in numbers, we vote, for instance, on around 100,000 ballots a year, and with the engagements we're invested in around 12,000 individual equity issuers across the business, but then there's also fixed income issuers and private markets alternatives as well. And we try and be consistent in our stewardship across those asset classes. And so one of the real challenges is making sure that we can deploy limited resource effectively. And the way that we approach our prioritization is in a couple of different ways, and really trying to think about how in the middle of the business we can be additional to the active ownership that's already going on within our investment teams, some of whom, or most of whom, have very sophisticated programs on engaging on ESG issues, but also on conventional governance issues and financial issues as well. And so we really rely on data to prioritize effectively. So I can't sort of undersell how useful accurate and comparable data is across a global marketplace, because it's really the key through which we can make our work effective rather than just voluminous. And so we think about prioritization in a few different ways, one of which is through our own exposure to an issue or an issuer, but also an issuer's exposure to us, as how big we are as a shareholder or how many assets we represent, because that we use as a proxy for how effective we can be in driving change. And then the last sort of filter that we have on this is concentration of thematic risks. So that might be where a certain issue is driving a significant percentage of biodiversity risk or carbon emissions risk, or other kinds of essentially data-driven assessments of where thematic risk may be concentrated. Then that will be how we prioritize it. And we split those thematic risks under the sort of economic capital, natural capital, and human capital pillars that allow us to sort of organize our engagement efforts a little bit more effectively. There's a sort of final piece as well that's a really driving feature in trying to decide how we engage and how we can be effective active owners, which is what we're really looking to do, is have collaborative relationships with management. And so our relationship with management is another feature in there. If we feel that we can have effective long-running engagements that span multiple issues, we think they're more likely to get to a beneficial outcome for our own clients, other shareholders, and the company itself. Then that's an engagement that we'll really want to commit to, because actually what we're not looking to do is sort of jokingly in some of the work that I do say, well, look, it's not my job to do more engagement, it's actually my job to do as little as possible and make it as effective as possible. Because Franklin Templeton is a very large manager, and we cover a lot of different securities. And so really what this team exists to do is enhance our strength through or enhance our effectiveness of engagement through making engagements more outcome focused, clearer to issuers, clearer to our individual fund groups, and kind of allow us to actually work on going straight to outcomes over just driving lots of volume of engagement, which is part of it, but not the full story.
Yeah, absolutely. It sounds like a very effective method of working there. And I can imagine that, having more reliable data would really help you to drive those strategies and be more effective with your engagement efforts, as you say. So when we think about the wider context in the industry, data gaps, regulation, market trends, how are the current industry trends affecting how you work as a team? Does it change your engagement efforts depending on what's happening in the markets, where your investment teams focused are, what assets you're kind of focused on in that period?
Yeah, so obviously we, the heart of what we do is that we're managing funds in line with our clients' preferences, and so certainly, what our clients are asking for is a huge portion of, how we define what we want to engage on, because it's ultimately their assets that we're stewards of, rather than our assets. And so that's, I think, one of the founding principles. But really, the other thing is that we really look to try and focus on what is going to be driving long-term value, and sometimes that's aligned with market trends on sustainability and other topics, and sometimes it isn't. And so again, data is quite useful for cutting through that noise. Sometimes we're focusing on actually what are the long-term issues in the marketplace that we're trying to address. Franklin Templeton is very exposed broadly to, as all large managers are, to systemic risk, and actually every financial market participant is exposed to systemic risk. And that's one of the things that we take a lot of focus on, actually independently of market conditions, is where through our coverage we can meaningfully address where issuers are externalizing costs on the marketplace, what are the drivers of systemic risk, and how we can kind of contribute to this idea that a rising tide lifts all boats. And there's still very much a piece of that that's focused on idiosyncratic engagement, because the rising tide doesn't lift the boats with holes in them. But broadly speaking, addressing that systemic risk is a big focus. But in terms of one of the market trends at the moment, we've obviously seen a very large increase in both the amount and the range of sustainability-focused regulation with and standard setting guidance. So it's obviously the SFDR, which people have been talking about for a number of years in Europe, and the SDR now in the UK, and that's, from my perspective, got some very significant features in it for someone that works in active ownership, with the Sustainable Improvers label, to think is going to be very meaningful in allowing managers to be very clear and transparent on where they view active ownership to have a part in the investment process, and where it can be not only useful for addressing underlying value, but also really aiding this transition focus. And rather than prioritizing asset allocation decisions in the secondary market to drive change on things like climate change, actually really relying on stewardship and using your ownership rights and remaining invested in economically important companies that are generating good returns, but also have large amounts of transition risk to overcome. I think that regulatory direction is very interesting, because it will allow us to be clear and accountable in how we're engaging with issuers to mitigate those risks and ensure that we can, on one hand, invest in the economy as it stands, and on the other, make sure that we're creating the right economic structure for sustainable growth in the future. And the sort of last thing that I want to touch on that is that we've also then got the third kind of major regulatory effort at the moment in the US with the SEC. Climate change disclosure rule for issuers, and fund labeling rules, and kind of this other suite of rules. And I think that the sort of overarching view is actually what financial markets need in all of this is interoperability, because as a global asset manager, what we really need is sort of standardized, comparable, verifiable disclosures from companies, and then that can allow us to do the things that we've always sought to do with financial data, but are also now hoping or seeking to do with intangible value and non-financial data. So if we have comparability and verifiability through, for instance, climate risk disclosures that are included in the financial statements, then actually that's going to solve a huge amount of the data problems that we have, because will then be able to ingest information about climate risk in the way that we do for usual market data, and then we can get to more accurate risk pricing, we can get to more efficient market allocations, and we can solve a lot of the hurdles that we're currently facing with regard to data integration of sustainability, which, whilst it's present, and there's initiatives like Climate Action 100 Plus that, for instance, have managed to secure in its first 5 years targets on 25% of global emissions, which is really significant, and corresponding disclosures on much of that. Those disclosures are generally furnished, and as a result are inconsistent across issuers, make it very difficult for the market to digest that information. There's a very high cost to consumption at the moment of sustainability data. So when this data is standardized through work like the ISSB is doing on sustainability standards, then actually we'll be able to get to this comparable, consistent information that not only will be clearer, but actually financial market participants will be able to consume it at much lower cost. And so that means that more of the market will be doing it. It won't just be the big, well-funded investment houses that will be able to access information about sustainability. It will be everyone right down to the individual investor. And so that will mean that we'll have, you know, generally better pricing across the market of these kind of risks, which I think is really significant for this kind of work.
Yeah, absolutely. It sounds as if there's a lot going on either side of the pond, and there are significant benefits for ownership teams. So do you think most managers will welcome these regulatory updates, both in European markets as well as the US?
Yes, I mean, I can't speak on behalf of every manager. I think, you know, different managers will have different views on this, but ultimately, I think personally, you know, I'm a big supporter of you know, better accountability both for issuers, so that their investors can, you know, make sure the right corporate governance and accountability is in place, so that so that management incentives are aligned with the incentives of their shareholders. But also for managers as well, I think the same is true that, you know, I'm very supportive of regulation that increases the amount of accountability and transparency to the end investor, so we can be very clear about about how we're acting in line with their best interests as well. So actually, the concept of better transparency and accountability is applicable at every stage of the investor issuer and client relationship, and so all kind of forms of regulation that kind of seek to improve that, I think, you know, are coming from the right place. But the devil with a lot of this stuff is really in the details, and there's this phrase that was referenced in a great paper by Tom Edmonds from London Business School about the role of regulation on sustainability in financial markets, which it has to be in equilibrium, in that the market failure has to be less than the regulatory failure, and every form of market regulation produces some form of unintended consequence or externality. And so the case is, it's about having well-targeted regulation that's properly designed to incentivize the right behavior in the marketplace. And so I think, you know, a lot of the principles are cross-cutting internationally, but the differences that we'll really see in how useful these are in affecting change is how well they're written and how well they're implemented and how well the market digests them.
Yeah, as you say, if they're implemented well and written well, I can certainly see the benefits long term for the industry. Sorry, from an ESG perspective, as well as just a systematic, you know, integrating ESG with regular investment operations and not sort of differentiating between the two, so they can become more streamlined. But do you think that managers are quite prepared? Like, are you, for example, preparing yourself in the next year for these changes that are coming in? Will it affect how you operate and require you to step up and change how you operate as a team? And what are your goals for the next 12 months?
Yeah, so one of the big things, and you touched on it there, by taking into actually taking ESG as an integrated issue rather than a separate one. I think that's a really good goal broadly, is that what we're really trying to do in our approach is show that what really the role of investors with regard to sustainability is, and how rather than take ESG as this exceptional topic completely separate from the finance of everything, actually show that what we're really interested in is showing how a lot of this sustainability information, ESG information, or assessment of intangible value, however you want to describe it, is fundamentally related to the financial picture and to the fiduciary duty element and to the proper stewardship and management of capital over the long term, because actually company valuations are very much driven not just by tangible value but intangible value, and ESG, like anything else, is just a source of intangible value. And so showing how, showing actually that this is fundamentally part of the financial considerations that we would make in the investment management function. And actually what the change is that we've got access to new information about how the global marketplace works and issuers' relationships with it. That's really is what's changing. But all of this stuff is financially relevant. And so one of the pieces is now we're really expressing ourselves in this form of actually this is about managing our economic and our human and natural capital properly. Because I think what that does in contrast to ESG in terms of describing it is it shows much more clearly what the financial linkages are, because there's no F in ESG. And so I think one of the big goals as we kind of build out our approach this year, and I've been at Franklin for about a year and a half, and we're sort of right in the midst of developing our strategy centrally on this, is being very clear about what those financial linkages are, what the role of investors is in sustainability, and also vice versa, what the role of sustainability is to investors, and being very, very clear about that. This isn't an exceptional topic that is being bolted onto the investment process. So actually, this is right at the heart of good, sound financial decision making.
Yeah, very well said. I think that's a really nice way to close, actually. We have that question all the time, how do you define ESG? Should they be treated as separate? Should we address E, S, and G? But I really like the 3 pillars that you use, and that model seems very well thought. So hopefully, the industry kind of takes that mentality and these regulations help it. So we've got ESG London taking place again in November. I'm sure by then a lot will have happened and we'll be able to catch up and see where we are. So best of luck with your projects, and thanks so much for joining us on the channel.
No, thank you very much. Really looking forward to the next event.
Fantastic. Yeah, hopefully see you there again. And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.